All right, so 2 after the hour, I'm going to go ahead and get started here. My name is Jack Regan. I am a managing director with UHY in our Columbia office, and welcome to our presentation on the ever-changing Paycheck Protection Program loan and what is next. We're really pleased to have you here today. We're up to almost 160 attendees. Appreciate your joining us. We would like to welcome also our friends from the Midwest. We know that our friends in the Missouri practice have these monthly executive briefings that they provide, and we welcome you guys to the July executive briefing that we've been presenting as a firm. Leading the discussion today, I'm going to kind of play MC, is Harold Moan. Harold is the office managing partner and managing director emeritus, regional managing director, there's the title, for our Mid-Atlantic practice. And he and I have done several of these in the past. So hopefully you'll enjoy these in the next hour with us. Really, we're trying to set this up where Harold's going to give a highlight of some of the changes that have occurred over the past 6-8 weeks or so. We know everybody's kind of been webinared out with a almost paycheck protection and EIDL how to, so we just thought, hey, let's update it. And then we've got a series of questions in advance. We'd encourage you to use the chat window that is on the right-hand side of your screen. I'll be monitoring that through throughout the presentation. We'll be able to prompt some questions through the chat window. So Harold, I'm gonna turn it over to you.
Well, thanks, Jack, and thanks everybody for showing up. Jack and I are going to try not to take too much time on the presentation aspect of it. Like he had mentioned, there's been we've done lots of these webinars, and I think most people are somewhat familiar, and we want to make sure we have enough time for the second half of our time together today in order to get to all the questions. When I've done some of these for some other organizations, especially recently, there's just lots of questions, and hopefully we can give you some guidance. We may not know for sure all the answers, but hopefully we will be able to help you today. So today we're kind of going to go through the update of the PICS, what's changed in the Payroll Protection Program with the Flexibility Act that was passed. They actually extended the due date, so you can apply up through August the 8th. I don't think that was technically part of the Flexibility Act, but it was approved later on because they were supposed to run out, not take applications after June 30th. So I know there was a little rush there. Now I think everybody, I'm not sure I have any current clients that are applying. I think everybody who was going to had gotten their applications in, and most of them have already been funded. So some of the changes that were made to this program, they changed the term of the loan to a minimum of 5 years and a maximum of 10. Remember, previously it was two-year term, 1% interest rate, and basically for those people that got in under that plan, as long as the bank agrees to do it, I don't think there's a requirement that the bank does it. They can change the terms of the loan to match the new law.
Yeah, and that's another one that was really weird too there, Harold, because remember, the legislation said 10 years.
Yep.
That started all of this, but then the enabling regulations that came out shortened it to 2. So I think they had to try and backtrack at least a little bit, because 10 years sort of felt too long, 2 years sort of felt too short, and I think they've settled in on 5.
Yeah, and I'm hoping that they'll kind of stick with what they've kind of done here now and don't keep changing things. It just makes it really, really hard.
Yeah.
And then of course they extended the cover period for loan forgiveness, that you can now, technically what happens is you can elect either a 24-week or an 8-week, but it can't go past December 31st of 2020. And I know a lot of the questions that we got were kind of around the timing of your loan, your forgiveness application. And so we've got, you don't have to wait the full 24 weeks. It's almost like you have to elect 24 weeks. Then if it takes you longer than 8, once you've expended the funds, you'll be allowed to file your forgiveness application.
Yeah, and we'll explore that a little bit more in some of the Q&A at the end.
Yep, yep. And then we've got the cover period for the loan that was originally from February 15th through June 30th. Got extended to December 31st of 2020. So you can take until then, I believe, to come back to meet your full-time equivalent requirements in order to maximize your loan forgiveness.
Yep.
So that's a big part of it, because we've got lots of clients that are still restricted on what they can and can't do.
And we'll explore that again. I'm just trying to foreshadow a
Yep.
little bit. We'll explore that a little bit in the Q&A and talk strategically about, when it may make some sense, even if you've exhausted the paycheck protection payments, to delay the application for forgiveness so that you can take advantage of the broader period that you've got for the FTEs.
Yeah, and there may be other reasons also to delay it. Is just, I don't know how many banks are ready to accept the applications. I mean, I think they're still trying to figure out, just like when they first started this program, they had to figure out how to take a loan application for the program. So I know there's some banks that are accepting them. I think that it's slowly getting there where everyone will be accepting them soon, I believe.
Yep.
And then when you talk about exceptions to reduction in full-time equivalents, or the salary reductions that are going to impact on your loan forgiveness, they added 2 more additional things to the exceptions, so that you won't be penalized if you can't rehire employees if they refuse to come back, or the inability to hire someone who's similarly qualified. So, they're going to give you some of that flexibility, and then the inability to return to the same level of business, right? If you're, for instance, a restaurant, and I know here in Maryland, we're at 50% capacity. So you're not going to bring back 100% of your employees for 50% capacity. So they give you an exemption for an exception for those where the government has put restrictions on your ability to work. And I get lots of questions about how to document that. And like with a lot of things that are in here, it's kind of like for those of us that have auditing in our backgrounds, it's kind of like taking an auditor's perspective and making a narrative with a case of why you think you meet this exception, and putting in as much documentation as you can in order to provide them the information that they're going to need.
Yep.
The other big thing that I think everybody heard about was that now you only need to use 60% of the proceeds on payroll, which gave a little more flexibility. I think with the extension of from 8 to 24 weeks, I don't think that's really as much of an issue anymore, because you could use now probably expending it all on payroll.
Yep.
Now that it's gone 24 weeks. And then they changed the deferral period of your payments. I think originally it was like 6 months. Now it's until you submit your forgiveness application, and they put some limit on it that it's basically 10 months after the end of the cover period. And then the other big thing I thought was a big thing was originally in the act, there was a delay of employer payroll taxes, which is basically the FICA taxes that the company pays, that you could delay to paying for the whole year. You can pay 50% at the end of 2021 and 50% at the end of 2022. This was originally, you couldn't do that after your forgiveness application was submitted, but now they're going to let you do both. I think they're looking for every tool that they have in order to kind of help with cash flow, to keep as many businesses afloat as possible.
Yeah, and this is one, Harold, I don't know if you feel the same way. I don't think that that aspect of the changes has gotten as much play as a lot of the other, the 60% and the extension to 24 weeks. But that's that's a pretty big change that, has been added to the, the stay afloat arsenal, we'll call it,
Yeah.
and what you've got, the different flexibility that you've got to be able to use different pieces of these public policies to help your businesses stay afloat.
Yeah, it definitely doesn't get enough press. For those employers that have quite a few employees, it can be quite a bit of money real quick.
Yep.
So every little bit helps as you put together your cash flow for the next year, 2, 3 years
Yep.
in order to survive this. Yep. So we'll just kind of run over real quickly some of the previous basics of the PPP loan. Just your loan amount was roughly 2.5 times your 2019 average monthly payroll. You had to do good faith certifications by the bar that you needed the money. There was a handful of certifications. I think there was a question I think I saw on what came through at the previous to this was talking about what the audit is going to look like. There was a lot of press about every loan over $2 million getting audited by the SBA. I think a lot of that auditing is going to be around those certifications. Yep. In order to make sure that you have documentation as to why at the time you thought you needed these funds. Then of course the allowed uses, which I'm sure everyone is familiar with. And then the other part of this too that I talked about for a little bit, but then I haven't seen anything recently. I haven't heard any more talk about them fixing it, is that one, the forgivable amount is not included in your taxable income. But the flip side of that is that the expenses you pay with this loan is not tax deductible for tax purposes. So, it's kind of like I see that, in essence, even if my clients were losing money, they may end up having some tax liability because a bunch of these expenses that they've used this money for are not going to be tax deductible. There were lots of, I think, congressmen that came out and said that wasn't their intent, but as of now, they've not changed it, and Congress is going to have to do something because the IRS is basically just, taking this stance that this is what the way we read the law. So now Congress would have to overrule them, basically.
Yeah. And Harold, to go back to your earlier point, jumping back up to the first bullet on this slide of the loan amount being 2.5 times average monthly payroll, just, think about the mechanics of all of this now. You've got this 24-week period, so a 6-month period with which you're allowed to use the funds from this loan. You've gotten 2.5 months worth of payroll based on last year. So I think the thought is, and underlying your comment, that you ought to be able to use 2.5 months worth of payroll over a 6-month period. It just mechanically, and intuitively, It just seems like that's why, for the most part, you should be able to use these loan proceeds for your payroll and not even have to get down to those allowed uses that we bullet out here on the slide.
Yeah. So we'll just mention real quick a little bit of the EIDL. Gone through a number of variations through this whole process, and I've got a number of clients that have gotten both a PPP loan and then later on gotten a disaster loan. One thing to keep in mind is that a PPP loan is basically very restrictive on what it can be used for. Basically, the utilities, payroll, those kinds of things. A disaster loan it's more a traditional loan. It's not forgivable, can basically be used for any type of business expenses, including working capital, debt obligations, lots of things like that. So it has a lot more flexibility to it. I think that one thing that I just recently heard is that they were giving you a $10,000 grant when you applied they were supposed to give that to you in a few days. Took a few months for some of my clients to get that back in March, but that has run out of money and they're not doing it right now. So So as of, I think it was yesterday or the day before, they put something on their website that there's no funds available for that, but you still can apply. And it's got some great terms. It's a 30-year, can be up to a 30-year amortization and a 3.75 interest rate. It's just purely a loan though. There's no forgiveness component to it.
Or if you're a nonprofit, I think the rate's 2.75%.
Right, correct. Yep. Yep.
And this is another one I think you've got just, tremendous flexibility. And I know a lot of if you go back a slide or two, the folks were concerned, we'll go back one more. Well, I want to use the money for, payroll, or I don't want to use the money for payroll. I want to use it more for working capital. Well, paycheck protection really wasn't meant for working capital, but EIDL is. So I know we've talked to a lot of clients about, which bucket of money should they be using for which types of expenses. And I know we've been counseling, if there are working capital type expenses that you're trying to incur or that you need to incur, that the economic injury disaster loans are really, that's the bucket of money you should be using. You're not really going to be able to use paycheck protection for working capital. Paycheck protection is paychecks, that's payroll.
Yeah, and another aspect to remember this too is that, because I know it's come up with a number of my clients, is that if you have employees that you're getting an employer credit for COVID related leave or anything like that, you can't pay those people out of your PPP funds because you basically can't, in essence, double dip. So you can't get that, can't get the benefit on kind of both sides. So I know I've got clients that have had to make adjustments to what they funded with their PPP loan because of those credits. One other thing I'll mention along those same you can't double dip perspective is we have a number of government contractors. And if you're a government contractor and you've gotten this PPP loan, you got a bunch of other issues that you have to deal with, whatever agency you're dealing with, because in essence, you have to give the government a credit for your PPP money on your government contract. So, I've had a couple clients that have talked about basically using the PPP money to pay their employees, but for those 2 months basically that they use the money, they're actually not going to invoice the government for those people's time, because basically you can't have it both ways. You can't bill the government and have the cost of that contract picked up by the government through the PPP loan. So it's something kind of a little quirky thing that you got to make sure. Usually you have to, I think when you invoice the agencies, you have to identify that you got a PPP loan. So they'll be asking the questions, maybe not right away, but eventually they'll be asking the questions.
Yeah, and that holds true on the not-for-profit side as well. If you've got multiple grants against which you could post an employee expense and you've taken paycheck protection money, you're not supposed to double dip there. And I think, Harold, do you want to talk about a little bit about the advice we've been giving to our clients and non-clients alike about, where we should be depositing these sort of funds,
yeah.
and how we should be segregating those funds so that this audit trail, as we morph out of the use of these funds and over into the forgiveness, you can build that good documentation trail.
Yeah, I think it's really important to put this money in a separate bank account and almost treat it like an escrow. We've got a lot of clients that talk to us about it up front, that basically we put the money in there, and then as they expend payroll, we actually have them do a payroll calculation about how much of that payroll can be paid through the PPP, and then they transfer that amount of money. So for every transfer out of that bank account, we have a supporting documents, whether it's a payroll report or a worksheet that determines how much of it will qualify for forgiveness. And we're just very careful to make sure we have a document for every disbursement out of that account. One of my fears at the beginning of this is that I was going to have clients just put it in their checking account and commingle it with everything else. And I'm just like, yeah, I could see the SBA, especially if it's one that's over 2 million, that's going to definitely get looked at. I could see the SBA going, well, you got 2 million, here's the transfer in, and there's, $500,000 of payments for things that are not allowable uses that happen the next day. So it's always a little concerning when they're going to come in and look at it. And I'll just mention while we're talking about that, the other aspect of that is you really are going to need to keep all your documentation around this for like 7 years, right? Because I think the SBA has basically 6 years to kind of audit your PPP loan. And that doesn't just mean the ones over 2 million. They can look at anyone. It doesn't have to be that big a loan. So, you're going to have to keep all that documentation. So you got to make sure you may have online access to your bank account, but you want to make sure you're actually printing out the statements, putting it in a file, and keeping it for that period of time.
Yeah, and I think our advice, if you have segregated those monies, has been you should have a set of documentation to support that drawdown. I'm thinking of, that account, like you said, an escrow account. You're drawing out of that escrow account, so you should have some supporting documentation that says, here's why I need, $50,000 out of that account, and here's how it ties to the payroll run or an interest payment on a mortgage obligation or rent or utilities or whatever else, what you're using it for, but you have a nice clean linkage on that.
Yeah, the other thing that my clients recently have had concern about is they think they're going to apply for forgiveness in like 2 weeks. They're going to know whether they've been approved for forgiveness or not. The process is going to be much longer than that. I think there's going to be 2 levels of scrutiny, one at the bank level, and they've got to basically then send it to the SBA saying they've approved it. And then the SBA is going to look at it and give the final determination. The lender has 60 days to review what you've given them. And the SBA then has 90 days after that. So you're looking at potentially 150 days before you will even know whether it's been forgiven or not after you filed the application.
So Harold, let's morph over into some of the questions that we've got here. And, we've gotten, I think, a lot of questions around this 8-week versus 24-week periods. And, several of them came in, was like, okay, I've elected the 24 weeks. Does that mean I have to wait all 24 weeks before I can apply for forgiveness?
Yeah, I mean, you can. The Treasury has said, yeah, you can apply as soon as you're done expending the funds. The one thing I think you have to keep in mind, because you want to maximize your forgiveness, is have you met the requirements as far as salary, what you're paying your people, and the measurement dates of your full-time equivalents, right? Because if you're not back to the same levels as previously, it could reduce your forgiveness amount. So it's really important. You got to do that analysis and say, do I meet those requirements to maximize my forgiveness now? And if you do, then clearly you can file your forgiveness application. If you don't meet those, then maybe it makes sense to wait, right? Or maybe it's not even clear, right? Because maybe it's an issue of it's not, will you ever get back there? So it's really important to kind of do that analysis and have those and talk through what really makes sense as to when to apply.
Yeah, and Harold, I don't know that we've got a lot of good guidance right now around what SBA is expecting to have in terms of documentation on FTE, but I know you've co-presented some webinars with some folks on from SBA. You've you've been an auditor. You're a tax guy. What advice or what sort of recommendations do you have on what folks should be accumulating to support their FTE calculations?
Yeah, I mean, and I think part of that too is if you outsource your payroll to ADP or one of the big national payroll firms. I know that we have some clients that have used some of those, and they've created some in-house reports to help them. but they're still developing them. So the question is whether you're even going to have the information if you have an outside payroll company in order to back up your calculation and your representations. I mean, what I've been telling clients and telling others is you really have to look at this loan forgiveness application as almost a little bit like a tax return, right? And you want to make sure you have documentation and backup to every number that's on there, and you're going to provide that to the bank. And, I think you've got to be prepared to defend your position because, and I don't want to make a generalization about banks, but, this is not what they're used to doing, right? And so they've got to go through, and I've already had some situations where some folks at a bank have told my client things that aren't really in accordance with the rules because they're not 100% sure what they're going to do yet. So you got to really approach it almost, going back. I know, Jack, you're an auditor too. You go back to your auditing days and you kind of go, all right, we need like third party, support for everything we're going to provide the bank. And I really think that's how you have to approach it.
Yeah, and I've talked about developing the support contemporaneously. What I'm really afraid of is waiting 30 days, 60 days, 90 days when you make a judgment call about whether something is or isn't forgivable and you're going to use these proceeds to fund an expense. Document your position at that time. Say, hey, here's the best information we've got available on this date, and this is why we're concluding that this is permissible treatment. The longer you wait for that, the harder it's going to be to remember why exactly you said, yeah, that's a good, good position to take.
And we were trying to encourage our clients to do that back at the beginning of this whole thing, especially around those certifications, because when they first passed these and came out with those certifications, you think it means one thing, and then some big company does something that doesn't make the government feel comfortable. All of a sudden they start backtracking and saying, well, that's not what we intended it for, but that's kind of what the law says. So, it's really important, I think, even back then, and if you haven't done it, to go back and do it as quickly as you can, to document kind of how you felt you met all those certifications.
Yeah.
And it's going to be really important on the bigger loans,
Yeah. And, to that end, in terms of, documenting specific people or specific employees, we got a question in, and, thanks for starting to hit either Harold or me up. Hope if you're sending emails, send them to me. Harold is the one that's not, I'm sort of prompting the questions here, but got one from somebody that says we have a handful of employees out of 180 that work on a federal contract. Can we calculate our, sort of covered or forgivable payroll, excluding those few employees that are working on the federal contract when submitting costs for forgiveness? So I guess, can you specify, hey, here are the employees that I am specifically using this paycheck protection money for?
Yeah, I think what's really important too is that you have that conversation with your contracting officer, right? Because they're going to be the ones that are going to accept it. And I've got a client that does a lot of work at NASA, and it's been shut down here locally in Maryland. But yeah, you've got to, I think, based on what we have today, any rationale like that makes sense to me. And it's about documenting it, but it's also about making sure the agency's okay with it. Because I can tell you that my guess is that what will fly at one agency may not fly, what may work at NASA may not work at the Department of Defense. So it's really, really hard to answer that question. But on the surface, it seems like you're not double dipping. So I would think that would be acceptable.
But that will serve as the basis for the conversation, is to be able to say, hey, look, here are the specific employees that I'm using paycheck protection money for. Here are the ones that I'm using on your government contract, and the two don't meet. So that's how I'm, demonstrating to that CO that I'm not double dipping.
Yeah, in reality, it gets even more complicated than that, right? Because sometimes you have support people that aren't really being charged directly to that contract, but
Yep.
you're charging through an overhead
Overhead
rate. So do you have to adjust the overhead rate for those people that you got paid by the PPP? And I don't know that any of us really know for sure what the answer is. But it seems that on the surface that, yeah, you'd have to make some adjustment to it because you got a PPP loan.
Yep. Going back to the whole 8-week versus 24-week, and this is where question came in about the intersection of when the FTE calculation starts or stops here. So if let's say that they exhaust their paycheck protection money at the end of week 20, does the FTE calculation stop at the end of week 20, or can you have the FTE calculation run the entire 24 weeks?
Yeah, I think you can do either, right? I
Yep.
mean, you can either, it's your FTE calculation happens when you apply for loan forgiveness. So if you do it right away, you've got to meet the requirements then. If otherwise, you can wait to the end of your 24 weeks, but that's kind of the window, right? That's the end of your window. So yeah, you got to determine what's best for you. And I think you can pick and choose anywhere in there.
Yep. Here's an interesting one that came in as well, Harold. We've got a situation where an entity has received a paycheck protection loan. He's utilized the funds as a business owner, but now he is not going to run that business anymore and is going to move over to take a job working for another company where he gets a W-2. So does the fact that, sometime after the paycheck protection monies have been exhausted, he takes the W-2 on, job, does that put him at risk at all for under the Paycheck Protection Program guidelines?
Yeah, I mean, I don't know that we have an answer for that that's documented anywhere, but I'll tell you that I think that's an example of what the program was created for, right? So when he's
Yep.
self-employed, he got his PPP to supplement his self-employment income during the pandemic. And I would think that as long as he met all those requirements for forgiveness, he can get that forgiven. But now, he's going to get a W-2 job and be an employee. So the goal of this whole thing was to keep people off unemployment. And I think that's a perfect example of that happening. And so I would think that, yeah, he would be, I don't think it would impact his, because there's no requirement that you have to be in business for any period of time after that.
Right.
I mean, I think there's lots of restaurants that are trying to figure out whether they're going to be in business by the end of the year.
Yep. So, and the point is you have to declare, hey, here's the end date of my business. And then
Yep.
that sort of anchors the last date through which paycheck protection money can be used. And anything else then falls into the non-forgivable category.
Yep.
We got a question in, Harold. Everybody feels really confident, I think, in being able to pinpoint payroll costs that come in and be able to separately identify those. But there's, usually I'm paying benefit costs on a monthly basis or some other. It's not on the same pay cycle as the payroll payments. So any advice on how they should track or how they would report as paid the applicable benefits costs?
Yeah, I mean, the benefits costs, I would look to I think there's some good examples in the regulations that, your healthcare costs, you can try to match up as best you can, because I think they gave you some flexibility at the end of the period, whatever your covered period is. So I would tend to default to when I write the check and when I pay the invoice and try to match it up as best as possible. I think that the 401k contribution gets a little more, if you have a 401k and you have an employer match, and maybe you only pay that in once a year. Again, I don't know that we have specific guidance, but I would think pretty much any kind of rational approach to that for that period would work. It's kind of like when I've been on these other webinars with folks from the SBA, they always like to kind of talk about, they know what's unreasonable. It's kind of like the sniff test, right? You know when it's unreasonable, but there's lots of gray area that I don't even know that they know. So for instance, at the beginning of this whole thing, I had clients who would be making their employer match in 2020 for 2019, and they wanted to know if they could make it all. Usually they would maybe make it when they file their tax return, maybe in September. And they wanted to make it now to use PPP funds to cover it. And my comment to them was, well, there's nothing saying you can't do that, but I would be hesitant to do that because I don't know that that passes the sniff test as far as what's appropriate.
Well, and here's another one that I think would fall into that sniff test category, which I suspect is something that folks have had happen, which is, I'll calculate the base period in the prior year for the loan app. But sometime before the loan is approved, someone that was in that base category voluntarily separates from the company, and that position has not been replaced. Others have picked up that person's duties. So how do they handle that voluntary FTE reduction for purposes of loan forgiveness?
Yeah, I mean, I think they have some exceptions in there for people that kind of quit on their own, and whether you replace them or not. And I think it goes to documentation and making your case. I would make the case that, you didn't do anything purposefully to reduce your FTEs, and this was something that happened just by that person quitting, basically.
Yep.
I mean, you just chose not to replace them. I would think that you would have a case to try to fit that into one of the exceptions to not be penalized for that.
Yep.
And I think that's consistent with what's out there right now.
And along those same lines, how long do you have to maintain somebody as an FTE to qualify for full forgiveness? So if you furloughed or if you've terminated some employees this year and you're looking at potentially adding them back or strategically adding them back, how long do they have to be on the payroll for you to be able to tick over and say, yeah, they are in my calculation of FTEs this year to compare them to last year to make sure that I meet some of these forgiveness calculations?
Yeah,
I know it's a loaded question.
Yeah, I don't know that I know the answer. I mean, clearly, technically, I think it's 1 day.
That's right? Where I'm going.
If you're on the payroll when you apply for loan forgiveness, that's when the measurement date is. So literally, you could do that, and I would say that you would technically meet the requirements even if you let everybody go the next day. But again, I think that given the way the SBA massages the regulations as we go along, I wouldn't be surprised if I saw something that at some point in time that wouldn't allow you to do that.
Frowns upon that behavior.
Yeah, it kind of goes back to the sniff test, right? It's kind of like,
well,
but
I'll draw the analogy, Harold. I just read, I know it's beyond what we're talking about here today, but the airlines got some pretty significant support payments. I'm talking in the hundreds of millions to billions of dollars that they've gotten. And I know United just announced that they are likely to reduce their FTEs by upwards of 36,000 people the day after the period over which those support payments, when it expires, they're talking, they've already, because of the union work rules and things like that, they have to make this advance notice. So again, something that didn't feel right. Okay, I took all this money to keep them on board through the beginning of
Right.
October, but on October 2nd, I'm going to let them go. I think it's going to depend on how much political hay gets made of that. I'm drawing an analogy to this particular
Yeah,
situation.
I mean, I think that's the facts of the situation, right? I mean, it can happen in any business like that, because you get to the point, you may have gone into this with the best of intentions. I'm going to use this money. I'm going to keep my people employed. They're not going to go on unemployment. I'm going to get it forgiven, and you get it forgiven, and you kind of go, from a business perspective, you go, well, it wasn't enough, right? I have to do other things to make
Yep.
it through the next 6 months or the next 9 months. So that's where, I would be surprised if they could hold you, given the rules that are in place today, that they could have an issue with that. But
stranger things have happened.
yes, stranger things, especially this year, stranger things have happened. Yes.
That's right.
Yep.
Got a question that came in as well. We talked about the practical advice on setting up a separate bank account, but what if you're in the situation where you didn't set up a separate bank account? What sort of advice would we give to folks who didn't do that? And to give you a break for a second, I'll give you my take, and then we can let you glom onto it if you want, which is, to me, that's going to make it all the more important that when you have a payroll run or when you have a check run with which you are planning on using those paycheck protection proceeds, you have a very clear audit trail that says, out of this group of 20 employees, I'm using paycheck protection for these 8 employees, or I'm using this amount for this rent payment or this utility payment out of this check run, and that you link it to each of the discrete accounting events that are going on, and build that audit trail coming out of that if you've commingled those funds.
Yeah, I would hope if they didn't put it in a separate bank account, they at least did a separate accounting, right? So they made it on their general ledger, set up an account that they were going to kind of track the activity with these funds, so that at the end of the day, that's kind of like the substitute bank account that you would show what this money was used for. Other than that, I would just say, I hope it's a really small loan and it doesn't get anybody's attention. That's my only other hope, right? Because I don't know what you say to an SBA person if they come in and look and you got, $500,000 in on day one, and on day two, all these expenses that were not approved uses come out of that account. I mean, I don't know what the counter argument is for that. Hopefully there was at least additional funds in that account that you could make the claim that, well, we were using these funds even though they were commingled in this account. So.
Yep. And along the lines of that documentation, we've got a really good question here as well on, they understand the limit on payroll costs at $100,000. All right. And we know what the 8-week max is, and we know what the 24-week max is. But let's say that I exhaust the paycheck protection money at 12 weeks. Am I taking, doing the calculation of the allowable salary as part of that $100,000 using the 12-week amount, or using the 24-week amount? Let's say.
I think you're using the 12-week amount, right? You're using whatever period of time. Just like I was actually surprised when they went to 24 weeks and they said the limit was 46,000, whatever that number is. I don't have it right in front of me, but I was surprised they allowed that to happen. But having said that, I would think if you use somewhere between the 8 and the 24, that limit will be prorated, basically.
Yep, I agree with that. Question came in around overtime. I've got hourly employees. Sometimes they're working less than 40 hours. Sometimes they're working more than 40 hours. Can I include the overtime in calculating the average over the period of weeks that I'm seeking forgiveness for, as long as that average falls to less than or equal to 40 hours? So I'm calculating the 1 FTE.
Yeah, I mean, I think as long as they don't exceed that $100,000 cap aspect of it, I think you'll be okay.
What about for
I would,
purposes of calculating the FTE?
yeah, for FTE, you're 40 hours, you cap them at 1 or 40 hours. So you're going to be, if they're working overtime because you didn't bring everybody back, then you're going to have an FTE issue probably at the end of the period.
Right. I think the question was, if I work 30 hours one week and I work 43 hours a subsequent week, when I'm calculating the average for FTE purposes, am I capped at 40 hours for
Yeah, I think in the
using the
regulations,
FTE?
you're capped at 40 hours.
So even though I did work 43 hours that
Yeah.
week and I worked less than that in a different week, I'm not allowed to
Yep.
bring those hours back into a prior week.
Right. I would probably use the alternative method for calculating full-time employees, right? And go to 1 and 0.5. And I would make the argument that if they're only working 32 hours, it still equals 1.
Right.
I think I think they've let you enough flexibility that as long as, almost feels like as long as you're rational and reasonable and can convince the bank that that's okay, I would think, you'd have a good shot, because I think the SBA is really going to be relying on the bank's review of these documents in most of these loans, just because the SBA doesn't have the staffing to deal with it. Even though they have 90 days, I could quickly see them being just overwhelmed and having to make a decision and go, all right, if it's under this amount, if the bank says it's good, then it's good. I mean, I don't have any documentation for that, or they've not come out and said anything, but that's what it feels like when I talk to people at the SBA, because unless they're going to go out and hire someone to come in and do this for them, I don't know how they get it done.
And we've talked a lot as well about this 8-week and 24 weeks and anything in between on all that. What happens if you've elected an 8-week period, under the alternative covered payroll period? Does that automatically lock you into 8 weeks for non-payroll costs being involved there as well?
Yeah, I think they got to match whatever your cover period is. Now, like I said before, there are, for certain kinds of expenses, I think in the regulations, they've given you some flexibility at the end of that 8-week period that, if like your utility bill goes over that 8-week period, then even though you haven't paid it at that time, they're going to let you count part of it as part of an allowable expense. But yeah, I think, to me, it's kind of like, I almost feel like my clients should just be all electing the 24 weeks just because it gives you so much more flexibility. I can't think of any
what I was
reason.
just going to ask you. I
can't think of any reason why somebody would want to elect 8 weeks.
Yeah, especially since, I was thinking that there might be a little bit of an issue there if they said, we're not going to allow you to apply for forgiveness until the end of the period.
Yeah.
But once they took that out of the equation, and it's really, you can apply for forgiveness once you've exhausted your proceeds at any point in time up to the 24-week period. I think it took all the pressure of having to declare that 8-week period off.
Yeah, I mean, the only thing I could think of, the reason why you would elect 8 weeks, is if you met the full-time equivalent requirements at that point in time and you weren't sure you were going to meet them a week later, right? Because
Yep.
then it's all about meeting those requirements to maximize your forgiveness. I mean, those are going to be the only circumstances where I think it makes sense to elect the 8 weeks, just because you have so much flexibility with the 24 weeks.
Yep. Just had a question that came in just for some clarification. Says even though an hourly employee who works overtime is capped at 40 hours for the FTE calculation, that doesn't cap the wages that are subject to forgiveness. You're still only subject to that $100,000 cap as prorated by the number of weeks in the forgiveness period.
Yeah,
Correct?
that is correct. Yeah. Yeah.
Yes.
I mean, I've had clients who have actually, for the employees that they have working, have actually given them hazard pay basically on top of their normal compensation. Just because, one, they're coming back to work, they feel like they're going above and beyond, and maybe they're not in the most safest of environments. And then it helps them use, as long as it's under that $100,000 cap, it helps them use up the PPP funds.
Yeah, I was going to be one of the other questions. It's not on here, but can you talk a little bit about some of the, shall we say, non-traditional payroll payments that you're seeing your clients at least consider? You just mentioned, hazardous duty pay, bonuses or other programs like that you're seeing folks get creative in using.
Yeah, there's lots of discussion that goes along the lines of, if you have employees that have some portion of their compensation that is variable, right? Whether it's tied to commission, whether it's tied to business activity. And so during this period, their compensation is going to be down when you compare it to last year,
Right.
because our economy was humming last year and now it's not humming. But their pay structure has not changed at all. And so from what I've been counseling my clients is, I feel like they have a good position to say, well, we haven't cut their pay at all. They're getting the exact same compensation as they got before. They're probably even working the same number of hours as they did before. So the full-time equivalents are all the same. It's just, if you were to compare the number that they were being compensated at now versus what it was in 19, you could say there was some kind of pay cut, but it was nothing that the business owner did. I think that's defendable to say, well, I haven't slashed compensation by 25%, even though maybe they're making 25% less. So it's usually around those kinds of things. And then, trying to come up with documentation to back up these exceptions when they try to fit into one of these exceptions. Like you said, whether somebody left voluntarily or like I had one client ask me, well, how do I document that the government isn't going to let me open, right? I mean, because they're open, but they're restricting. So it's kind of like they have to go back to the executive orders that the governor has produced in order to put in their loan package to show how they were impacted. So it's definitely a moving target sometimes.
Yep. And can you talk a little bit, Harold, about the owner employee allowable forgiveness? I know there are a lot of questions around, what is it that the owner is allowed to claim as, their salary, or what are they allowed to get reimbursed for under paycheck protection?
Yeah, the owners kind of have a little bit of a bullseye on them. I mean, the one thing they didn't want to see is owners increasing their comp in order to help use up the PPP fund. So even when they extended it to 24 weeks, I think the cap for an employer is 20-some thousand, right around 20 grand. And that's all in, right? That's your comp, that's your benefits, that's your 401k match. It's all those things together. And even when they extended it for 24 weeks, they didn't increase the cap for owners.
Right.
Like they did for regular employees. And I think that kind of goes back to what they were trying to do. They were trying to keep the employees on the payroll not necessarily the owners to the same level as employees. So, but yeah, they do treat, and then I've had clients go, well, what's considered an owner? And it's basically anybody who has any ownership interest in the business, no matter how small, right? So I've got some clients where there may be owners that maybe own 1% or 2% of the company. Well, they're still technically owners of the company, so they're going to have this cap on them, no matter how small their ownership interest.
Wow. Two more questions. I know we're running up against the hour deadline here. Do you have to use the same methodology for calculating your FTEs, both at the beginning and the ending calculation, or are you allowed to use, what I'll call a traditional method for one of them, and the 1/0.5 method for ending?
Yeah, no, it's got to be consistent. I mean, in all the documentation, all the instructions, I mean, it's got to be the same methodology for all the different measurement dates when it comes to full-time equivalent. You got to make sure you're comparing apples to apples, no doubt about it.
Well, and I did get a follow-up on your question or the response on the owner. Any difference or any different treatment if it's an employee-owned S corp?
Ooh, that's a great question.
And we don't have to answer that specifically today at 2 minutes before the end of the webinar.
My answer is going to be a little bit hedged. It would depend how the employees own their ownership interest, right? So if their ownership interest is held through an ESOP, I would probably make the argument that they're technically not really owners.
Right.
If it's owned individually, just straight up owning the shares of the stock of the S corp,
that's a little bit harder.
I think they're owners. I think they're owners. I think if you can put them like one step away through an ESOP program, then maybe I would feel comfortable making the argument that they're not owners.
No.
But that's a great question.
Yeah, that was a great question. And the last one that I've got before we conclude is, once the loan is funded, do they have to start using the money like right away and document how, I used it for a payroll 2 weeks after I got the funding or 4 weeks after I got the funding? Or can I let it sit there for a little bit and then start drawing it down at some other period over the 24 weeks that I'm allowed to draw it down? Do you have to demonstrate that I started using it right away?
No, I don't think you have to. I mean, I have a client who hasn't done that. I mean, they got their money and they left it in the bank account, and they got their money before they gave them this 24-week option, and because they were considering just giving it back because they didn't want to start using it because they had no business to bring their employees back for.
Right.
So yeah, you can hold on to it. The key is you still have to use it in those 24 weeks.
Yep.
Right. So you can wait 4 weeks and then start using it. There's no need to expend it right away.
Yep. Well, that concludes our webinar for today. We're hitting it right at the hour. Harold, I don't know about you. I like this format a heck of a lot better than the Talking Heads format.
Yes.
Where we're just out there prattling on for an hour. This one worked out really, really well. If it worked out well for you guys, hit us up with an email and let us know, because we would look at revisiting this sort of thing every 4 to 6 weeks, where we could put out there another an hour-long session like this where we're really entertaining questions from the studio audience on things. But
and hopefully in 4 weeks we'll actually have some stuff to talk about on how it's going with getting the applications into the bank and the bank's reaction to what we're doing. So
We appreciate everybody joining. Again, you've got our contact information if you've got further questions. Enjoy the rest of your day. Stay safe and wash your hands.
Yep.
Bye, guys.
Thanks, Jack. Thanks, everybody.